Chapter 6, Accounting Periods and Other Taxes. In this video, we'll be discussing 6.4, Applying Rules for Unearned Income Taxation for Minor Children and Certain Students. Many parents have found it beneficial from a tax planning standpoint to give income earned from assets such as stocks, bonds, bank certificates of deposit, and mutual funds to their minor children. Since children are generally in a lower income tax bracket, their income earned from these assets, such as interest, dividends, and capital gains on stock sales, has traditionally been taxed at a lower rate than the parents. To prevent an income shifting strategy such as this, tax rules have long required the child to pay tax at the parent's rate, referred to as the kiddie tax. The child's tax was first computed using a with and without computation. First, compute the parent's tax without the child's income. Then, recompute the parent's tax with the child's income. The difference is the child's tax. In an effort to simplify the tax of the child's unearned income, the TCJA changed the rate on the child's tax computation. Instead of using the parent's rate, the child now computes tax using trust and estate rates. The tax on a child's unearned income applies to dependent children who are ages 18 or younger, unless they're a full-time student, which is between the ages of 19 and 23, who have at least one living parent and have net unearned income of more than $2,100. So how do we calculate this? First, we have to calculate the child's taxable income. Taxable income is equal to the child's total, both earned and unearned income, less their allowed standard deduction. The standard deduction for an individual that could be claimed as a dependent is the greater of $1,050 or earned income plus $350, not to exceed the standard deduction. Remember this when we're talking about standard deduction amounts. Go back and look at that chapter if you need to on how to calculate this. Once you have calculated the taxable income, you calculate the net unearned income. Net unearned income is generally defined as unearned income less $2,100. Unearned income is income not derived from wages, salaries, or similar compensation from a trade or business. More generally, unearned income is thought of as investment income, such as interest, dividends, and capital gains. Step 3, calculate earned taxable income. Earned taxable income is the residual amount of taxable income after reduction by NUI. In other words, it's step 1 minus step 2. Taxable income minus NUI is your earned taxable income. Step 4, calculate the tax. The tax on the NUI is calculated at trust and estate rates, and the tax on the earned taxable income, or ETI, from step 3, is calculated at the rates applicable to the child's filing status. There's some really great examples, A, B, and C, in the book under Learning Objective 6.4 to walk through 3 different examples of these step by step. I highly recommend that you go through and take a look at these. If certain conditions are met, parents may elect to include a child's gross income on their tax return. The election eliminates the child's return filing requirement and saves the parents from the trouble of filing the special calculation on Form 8615, which is the form the kiddie tax is calculated on. You may only qualify for this election if the following conditions are met. If the child is under the age of 18, the gross income that they have is only from interest and dividends, the gross income is more than $1,050 but less than $10,500, and no estimated tax or backup withholding has been withheld. So on those interest and dividends, if those 1099 div forms have withholding held from them, then you cannot elect to include it on the parent's return. Or if the parents paid estimates throughout the year because they knew that this child was going to have high interest and dividends, then that child would still have to file their own tax return.